episode 3 of Do What Banks Do and Hidden Gems come together. I think last time when we talked about more understanding the infrastructure of infinite banking, and then we just talked a little bit more about buy term invest arrest, talked about IUL, kind of floated around on some of the topics. But recently, I had a couple appointments, and I definitely some feedback. We always we don't agree on everything, but you know what? Sometimes we do, sometimes we don't. We all have our own different ideas and different strategies, and they all work. It's just different ways of doing things, which is awesome to have collective minds like ours in this industry. But yes, I did have a client. It's a 3.5-year-old client, and we were trying to figure out how we were able to keep the account open and active because let's face it, times are tough, and being your own business owner as in an HVAC air conditioning company and being in Florida, you would think people want air conditionings, right? And they break. But he's having a tough time struggling because, transmissions are going, his salespeople are quitting. It's just, so we designed it very optimal where he's only paying $300 a month. But everyone always thinks that these are expenses, right? It's like an added expense, not understanding and remembering the conversations we had 3 years ago that these are assets, right? It's not expenses. And all we did is a deeper dive and did a quick review to figure out where is the money, right? And that's kind of how I was able to save the account. And we were going back and forth. We probably had at least 3 or 4 meetings, Zoom meetings, where I showed him how his policy works and how we're going to be able to find the money. And it all comes with doing another client intake. And I think that's where some of these agents fall short, Wayne. You can either hop on and piggyback off what I'm going to say, but you might find that a lot of the agents in our industry that you well know, they're good at selling. They're not good at retaining because they don't call their clients back. They just sell and keep going. So I call that more of the car sales mentality, right? You sell a car, go on the next one, walk through the door, you forget your old clients. And I try to build and educate and train agents to be more of a doctor, right? Because doctors retain their clients, which is why people just sit around in that waiting room for 30 minutes or 40 minutes or even hours because they love the doctor. So that's kind of where you have to build. I mean, your take on it, what do you think? Because you've been in this industry, just as long as I have, understanding agents that you work with in your organization. What do you see when it comes to the relationship between them and signing up the first client and then years later?
So you really said a lot there. And I think, man, that's why I started jotting down notes. It's a product, and I just did a recording on this the other day. I went live because it's one of the most irritating things that I see happening in the industry right now, where they're promising people the 6-figure income to come to insurance and sell these trucker IULs or these IULs for insert whatever area of expertise here. And these people don't really have any experience. They're coming for the 6-figure income. They're not coming because they want to help people, because they have a background, because they have a knowledge base. And as a result, they're here for the paycheck. And once they get that paycheck, which the IUL very much lends itself to, because they don't find out until it's too late that it was the wrong product to begin with. Once they get that paycheck, which is, again, 4 times as much as if you structured an infinite banking policy the same way, they're gone. And you and I have talked about this before. Even the IUL itself, the relationship aside, is something that needs to be managed. And if it's not managed properly, aside from the inherent risks of just having that vehicle itself, if it's not managed properly, then it can go left in a hurry because you need to adjust your strategy reallocations and things of that nature. So that's one of the reasons. And it's interesting that you said do another intake form because things change. And like you said, they don't necessarily know where the money is. And one of the other things that I alluded to in that live is the fact that it's a foreign language and they're going to retain whatever they retain. And that's what helped to make that decision. And that's what they're going to hold on to. So the other intricacies of the policy that will help them in those situations, like I'm sure you talked to them about leveraging the cash value that he did have to offset the premium, things that they don't know to ask, which is why these recordings are important, or a community like the one that I have over on Loop is important for your clients and agents alike, because let's be honest, with the agents, the way that they're coming to the industry, they got a lot to learn too. So they might as well be in the same conversations as the clients that are trying to make educated decisions. So I think obviously I I could only imagine how that conversation went, because I've taken so much from you in this space that they're undoubtedly in a better position now. But it really is a resource, and no different than a carpenter when he finds himself in tough times. He's not going to off his hammer and throw his hands up. He's going to find a different way to use the hammer. And that's essentially what you did with the policy. It's not an expense, it's an asset. Just like the hammer makes some money, this policy will make you money as well. And especially if you've been in it for a while, I think you said 3 years, he's at that sweet spot where it's essentially paying for itself at this point. So the thought of it being an expense should be the furthest thing from his mind at this point. It should be self-sustained. As long as he maintains the premium, he's getting that back in dividends anyway.
He is. He was on what's called extended term.
Yep.
Because he had stopped paying some of the premiums, and then it switched over from the paid up additions, like that extra savings money, and just switched over to the base of the term and just the PUA minimum to keep it active.
Right.
So what we did is restructure it where we had them go back and approve the extra over PUA, right? So that he can add that back into it. So he was looking to just cancel and walk away from this asset, not understanding what he actually had in his hands, right? Because all we think about is this is an expense for me. We can't afford the $300 a month. And once we had those meetings, we finally tapped into the core of the concept. And that's where he said, I finally understand. Yeah. It just took me a couple more years and a couple more meetings to finally understand what we're doing and how this is working. And I think what really clicked for him is I was so transparent, showing him the 4 policies that I have in my own household.
Yeah.
2 for me, 1 for my 6.5-year-old and my wife, where, it shows transparency, number 1. And number 2, if they see that it's working for you, they understand, like, you're not going to put money and you're not going to sell me something you don't have, right? And receiving my dividends this past December, I mean, heck, $12,000, just about like $11,934 on almost that's been loaned out already in the last 5.5 years on my own policy. Are you kidding me? Like, who the heck in any financial industry or financial institution is going to give you $12,000 on money you owe them, right? Regardless if you pay it back or not. Like, I've never heard of an institution that's like I have a mortgage on a house, let's say, or whatever, and the bank's still paying me 5.something% on the money I owe them. Like, no one's going to do that. But when you show them that, it validates proof this stuff is reality. And the next question is out of his mouth. Guess what they all say? Why don't they teach us this? When this is like, why aren't they teaching?
It's either why aren't they teaching us this, or I wish I would have known about this sooner.
Yes, exactly. One of those 2 different ones. And the key is this. If what I just showed you on my own personal policies for me, my son, and my wife were reality, and they taught this to you, would you ever put money and give money to a bank? No. He says no. And if I showed you what we're earning on the money that we put in and borrow at the same time, because the companies we work with are non-direct recognition, which is very different from direct. And we can have another conversation about that later on. But that's where agents and consumers don't understand. They look at the benefits and the features of that trifold. They listen to those YouTube influencers with 3 million influencers and followers, but they have no clue the carrier that they have. It sounds good, looks good, but not understanding what you have with the specialists like you and I in this industry. We know the core in depth of how these things work. But doing that, would you ever give Wall Street your money if you know you can never lose here? No. Well, now you know that if they taught you this, you wouldn't do it. We wouldn't have Wall Street. We wouldn't have banks using our money. So that's why they don't want to tell you. But that's why the banks are the largest holders of these things. BOLI, bank-owned life insurance. Corporations do the same thing with COLI, corporate-owned life. Wealthy people and business owners, they understand this because they, number 1, think outside the box. Yeah. And number 2, they don't listen to everyone else. So you got to think outside the box when you're doing these things, and you got to be an open-minded person. And that's the core thing. And after we restructured all this stuff, we got it back normal to $300 a month. And then I just asked some more questions on that client intake form. Right? So I went back, did a whole new review. And whether you're doing this with your clients, Wayne, or you're teaching your agents how to do this, I think instead of getting new leads and finding new people, go back to your core clientele, which is what I'm starting to do. And I'm finding more business by just providing the service for free, right? Showing them what they're currently doing or they're not doing, and then positioning something for their child or their spouse, or maybe I caught an annuity from some old 401k they had for like $27,000 with the other client. You'll find more money if you just take care of your clients. But we found an old 401k, I think it was like from Publix or something when you worked younger. It was still sitting there for so many years. He had close to $19,000 plus, almost 20 grand, we'll round it up. And I don't give tax advice, even though my dad's an accountant. I said, look, I can't give you the advice. You're younger than 59 and a half. You're going to pay a 10% penalty anyway. 2,000, it's coming out. And if you're in the 20+% tax bracket, just imagine 30% of that 20 is coming out, 6 grand. So maybe you net 14 grand, and I think it was like 13 and change is what he got when he did this. And now what I showed him on the Debt Action software that we use with that Instant Rocket thing, man, I used that, plugged all their data in. And once we put in the $300 a month and then threw in and supercharged and jump-started that 14,000, onto his paid-up additions, he immediately was able to borrow, I think it was like 11 or 12,000 back out because he had a little bit extra cash on the premium. Mm-hmm. And we knocked out the credit card debt of 3 credit cards. He had enough to pay the transmission on the new truck for the air conditioning business. And he had a little bit of money left over for the advertising marketing he needed for a sales guy. And they were blown away. They were crying.
Yeah, the reallocation of funds is powerful. And you said something I want to go back to before we address what he was able to do is he was sold when he saw how it was working for you and that you were actually utilizing it. And one of the other things that we say a lot is just ask your agent to see their policy, not their illustration, not a projection. I want you to ask them to log into their portal or get an in-force illustration of their policy for the next meeting and walk you through that.
The annual statement. There you go.
Or an annual statement because of what I said earlier, most of these people don't believe enough in and I'll say a product because the way that they're positioning it as a product, it's not a resource. Don't believe enough in the product that they're selling you to have one themselves. And I wholeheartedly believe that everybody should have an infinite banking policy. That's why I struggle now because when somebody says, who is it for? I'm like, I could put you in a box and I could tell you it's for the people that are here. But the reality of the situation is, just like you said earlier, if you knew this, you wouldn't put your money in a bank. Like everybody should have one of these, just like they tell you everybody should have a bank account. Like everybody needs one of these regardless of where they are because you can stack them as you ascend through the different stages of life. So there's no reason not to have one because of the flexibility and control it gives you over your cash and your finances.
So flexible. And you mentioned that's key word. Because a lot of people, when they look at, YouTube or social media and content, they'll always go to like Dave Ramsey or the money guys talking about, infinite banking life insurance itself, right? Right. Is a bad investment. Yeah, it is a bad investment because a life insurance policy is not an investment, right? And we're not talking about traditional whole life like your broke brother-in-law is trying to sell you, right? Or what Dave Ramsey talks about where it's 100% base and it kind of looks like an IUL where the first year or two you got no cash, right? You're paying full cost for the death benefit. We're talking about a modern way to design these things where, it's so strategic, right? And so structured that's very different. It's so much more flexible, in my opinion, than anything else. But to piggyback off what you said, it was something very key. You said it may not be for everyone, or it could be for everyone. It all just depends. It's a loaded question when someone asks, who should this be for? Who should have one? And it brings me back to like 20-something, almost 30 years ago. And I'm probably showing my age right now, but you and I are around the same age. But if you remember back in the day, and a lot of people listening to this might recall, there was no direct deposit, right? You worked a job and then an envelope, right? And you had 2 options: get your ass in the car and drive to the bank, and you can either deposit that check or you can cash it. So I hate when they say don't put all your eggs in one basket, but guess what? We have been giving our eggs to the bank. Like all of our eggs are sitting in one basket at the traditional banks before you take money to go invest it, take money, go buy cars, take money, pay bills or buy food. It's sitting in the bank account. And that's where you're giving all your eggs. The difference is we can't give all of our eggs to the policy, even though I wish we could, because a life insurance policy is not a bank, brick and mortar, and it's not an investment. But we can structure it where, maybe a couple expenses, 3 or 4 months worth of expenses are in the bank, and then all the surplus money, our savings, can be put into the policy and the overfunded paid up additions, and now it's stored in the best savings account possible, right? That's where I want my eggs first, before I borrow money, right? Like right now I told the client, because another client asked me the same question, well, I can make more money in like a Roth IRA, or I can invest it somewhere else. And I said, that's okay. But if there was a better way to take right now $10,000 from your savings account over a Capital One, move it in your policies, paid up additions, And then within 30 days, you can borrow $7,500 back out to go ahead now and go invest it in a Roth IRA. Well, now you have tax-deferred, tax-free growth, right? Distribution in retirement. And you also have dividends on the same $7,500, which is really the $10,000 piece of the pie, right? But then they always say, well, don't you have to pay it back? I just took a loan. I could just pay $7,500. Well, yes, but if you pay $7,500 for your Roth IRA from your bank account originally, don't you start having to save $600 plus a month anyway for next year's Roth? Why wouldn't you want to just pay the loan back the same way you're saving and just change the different terminology? Because you're still earning dividends within 4 to 6% on the same money and your Roth IRA. Don't you want your money working in two places at once? Doesn't that just a smarter way to have your money work for you? They don't understand. Like, this is possible.
Yeah, no, absolutely. And the fact that it's an insurance account, it's an insurance policy in its purest form. So now if you put the $7,500 in a Roth and something happens to you, at $7,500. You put it in
That's
a
right.
insurance policy, something happens to you, your family has $250,000, $500,000. And I mean, just common sense, which one puts your family in a better situation, not to mention the living benefits. But you set up, and for that reason that you just discussed, taking that $7,500 out within 30 days and putting it in the Roth is the reason that I will combat what you said about keeping 3 months of savings in the bank. Because if I can access the money inside of 30 days from when I put it in there, I really only need to keep 1 month's expense in the bank and put the rest of it in my insurance policy where it's working for me and growing consistently. Because the second I remove it from the bank, I'm not making anything from it. And the more I put in my insurance policy, the more I'm inflating the death benefit. The better off my family is, God forbid, because we're establishing these Roths and these 401ks and acquiring these properties, all these things to put our family in a better situation, to create a legacy. So and that's great, but if we start that process and never get to fully execute that plan and never ascend or accumulate the amount of assets that we wanted to, that we envisioned to make ourselves comfortable, then and something happens to us and our family is in a situation where they have to manage and maintain those things. If we run it through the policy first, again, it's creating that tax-free windfall that they have so that they don't necessarily have to figure out how to maintain and manage those things right away in arguably the most trying and tumultuous time of their lives. Now they have this windfall where they can manage their lifestyle. They can continue to make those payments until they can either, because you gave them that, hire somebody to manage it for them or liquidate it and not be forced into a fire sale so they can truly get the value out of it that is due to them. So there's a number of reasons why I have the pay yourself first mantra and why this is, when I position it, we're just teaching you how to reroute your money like you showed the gentleman earlier. And I think it's worth, because you said that, one of the first things that came to my mind was the credit card arbitrage play and how he used it and probably didn't even realize what he was doing, trading the 6% for the 18% and using the credit cards as a resource instead of them being the anchor that they have been thus far.
Correct. That's where I think the disconnect sometimes, it's really about re-educating, like you're saying. We have to educate people and retrain their brain to understand, stop thinking about this as life insurance, even though that is the byproduct of what we're talking about. Change the verbiage as assets. So we have an asset that just happens to be life insurance and not an IUL, not UL or VUL, and not a traditional whole life. This is like a modern whole life take of life insurance. We can just design this very differently than what you've been seeing, taught, or heard before. And that's the concept, is assets that we can leverage. That's the key words, assets and leverage, like real estate. And the thing is, we don't think about our 401k as an expense. But I've been telling people, what if the 401k, you're putting money in every 2 weeks from your paycheck, whether it's $250 a paycheck, $500 a month, because of your match money, your free money. Everyone says it's free money. They say free money. Well, that's an expense in my eyes, because one, it's coming out of your paycheck. Two, you're not touching it. And 90+% of people never touch it, never even know they can borrow money from it anyway. They just think of it as retirement money. But what if you die before you get to retirement? What about your free money when, 9/11 hits and 2008 hits, the worst real estate market crash, and COVID hits, and you're losing 20, 30% in these free markets match, and you haven't even touched it. And if you take it out, there's penalties and taxes, and you have debt. Why do you want that plan? when you can have this plan and you can utilize the assets immediately. So I know we said about 30 days. And when Wayne and I are talking about putting in money like that $10,000 example in the Roth IRA, brand new money, fresh liquid cash going in takes about, 7 to 10 business days to move hands, right, from bank to bank. But Wayne and I have money in our account to borrow. So those take less than 7 days to come back to us direct deposit. So every loan is like 3, 4, 5 days, maybe 7 business days. So that's the amount of time. It's not like Zelle. I wish it was. I moved that quick. We'd be in more transactions.
I would think I have a debit card attached to my insurance.
Oh man, that'd be great. But that's exactly what I'm talking about. You mentioned it. In credit cards, we're paying 15, 18, 20% plus to Visa, MasterCard, Amex, and all these companies. And we're happy to pay that, right? We're not happy, but we're paying it well above the minimums requirements. But you don't want to pay 6, 7% different, right? Would you rather forego the 20% for a 6, 7% and also earn interest on the same money?
Yeah.
And that's what I told the client. I said, you got a credit card over at Visa and you're owing like close to $18,000. And that's as if Visa called you up and said, we're still going to give you a cash back 5% on the $18,000 that you owe us while you're still paying the finance charge. Would you be okay with that? And he said, yeah, but Visa's not going to do that. But we are doing it here over at this IBC policy. So why don't we just do that? And it's kind of opening his eyes, but this takes people a little bit of understanding. I don't know if you see that with some of the clients that you have, like the verbiage, right? Expenses, and they think about life insurance very differently, and they ask you about dividends and spreads and loan rates. Do you see that happening a lot more?
Yeah, I think and I jokingly say that it's weird that some of the clients, for the first time, they're hearing these things, and then all of a sudden they get a policy and they become CPAs. Now they want to know where every cent went. And it's funny, like you laugh, I laugh, but I also understand that for the first time they have somebody that they can talk to, that they're confident will answer their questions, so they're comfortable asking the questions because you've built that level of transparency. And they've been misled for so long that's the way that they should go. And you call it a modern way of structuring an insurance policy, but this has been around forever. There's nothing modern about the IUL is modern. That's a modern vehicle. This is how people save for retirement before the Great Depression, and on the heels of the Great Depression, they pushed them into that other direction. So I think for those two reasons is why they ask those questions. But I enjoy those conversations, and I'm sure you do too, because it means that they're thinking about how to use the policy and they're open to learning, because people will receive what they ask for more readily than they will you just vomiting. So, and that's why it's important to have another discovery call so you can figure out, like you said earlier, what those pain points are now and provide a solution for that pain that re-engages them in the policy, which just compounds on why they got it in the first place. Because a lot of people are attracted to it now because of the way that it's marketed, or attracted to that vehicle because of the way that it's marketed. And it's marketed as infinite banking. And there's really only one way to do infinite banking. And then a couple years down the line, when something like this happens, the pain point is different. It's a different goal that they're trying to accomplish, which if you were in that vehicle, what you did with him isn't feasible because of the surrender charges that are levied on those policies for the first 7 to 10 years.
Yeah.
I think even longer in some cases, but
yeah, mine's 12. I mean, I've had my, and we can switch topics for you for a second. It's a good transition over to the IUL space, which you and I,
I think we both fell in love with the IUL at one point.
We can go in deep conversation on this one, but just to touch on that very sparingly, I've had my IULs for my son when he was born with just a social security number, because let's face it, the illustrations look fantastic. And 9+ years ago on mine, I still got 12. I think mine's a 12-year surrender schedule, and I still haven't peaked on that money I put in and contributed, and the amount of money that I'm able to borrow. It's ridiculous. And that's because, and even the regional vice presidents of these companies are teaching us how to sell these things, and they're using the same, hypothetical illustrations and the same, training methods. And it's very scary how corporations are doing the same thing, teaching agencies how to do this, because let's face it, greed is greed, money is money, and they want to be very profitable, and it's capitalist, area. I'm not saying the IULs won't all work. I'm sure if somebody manages the expectation every year on the indices and they change them, but who wants to manage something when you are getting basically a 99.9% guarantee that you're going to get a dividend, because these companies for almost 200 years have never missed giving us dividends through any recession? Why do I want to manage something so I can make a 10% return in 1 year and then 2 zeros? And just to give you an example, my son, when he was born, I got his policy 6.5 years ago. We had him in the PIMCO fund, and it was the best time. End of quarter, end of the year, in December, and it was like an 18% return on the PIMCO fund. It's crazy. But we had 2 more consecutive years of zero. How is that possible? We just had COVID when he was born. I should have an increase every year in different indices.
Yeah.
So it's like, are you crazy? Like, you kidding me? How is this possible?
And that speaks, that in itself, like, you understand that, and I understand what you're saying, 1800. And if you add those 3 together, 18 divided by 3 is 6%. So somebody on the other side would say you still average 6%. But when you really think about it, with the rising cost of insurance and then the sequence of returns, like, what that does to a policy is pretty impactful. And those people, I say those people because they are on the other side of the fence, but those people don't, I would venture to say, don't understand the sequence of returns. And the people at the top that are teaching them how to do it do understand it and are telling them this because they know that they don't understand it. And it's really about the bottom line and generating revenue. And by the time the client figures out that they should have been in a whole life policy, it's too late, because now you have to overcome the surrender charges. Like, what happens to the rest of the money that I put into the policy? Now I'm having to tell them that we'll make it up on the other side. And this is where the convincing comes in, that this is that much of a superior product that you should be comfortable making that transition, knowing that you have this runway to recoup that and never be in this situation again. It's like the Chinese proverb: if you're sailing across the ocean and you realize that you're going the wrong way, are you going to wait until you get to the destination to rechart your course, or are you going to adjust the second you figure it out based on the sun and all of the navigational tools that you have? You're going to turn now, as opposed to waiting until you get to that point to make that adjustment. And then it speaks to, in addition to the sequence of returns, even though it was 18%, I'm sure you had a cap and a participation that cut into that 18 that people also don't talk about and understand when they're positioning these policies. So there's just a lot going on when people are talking about this great vehicle that saves for retirement, tax-free, that you can borrow from, but not for the first 10 years because of it may it's ridiculous.
It's going to implode. I mean, but even for common sense and for everyone listening, just so you understand, like, I fell for it too. Like, don't get me wrong. And I did offer this to a lot of the clients and my friends, years ago, and I've tried to save some of them. I have saved some. Some of them I've changed and readjusted. And even on my own policy, I've called carriers with clients, just like my own, and I just asked them, what is the actual COI, or what's the cost of insurance just to maintain the policy? Not what I designed for myself from the RVP sales rep of the company told me. So I think, like, right now, instead of paying, I think it was like $6,000 a year, it's like $2,300 the first couple of years, and it was $3,300. So I'm just going whatever the cost of insurance is to maintain the death benefit, because I have a young child. And then all the extra surplus I was giving the overpayment. All that's going back to my other policy, my whole life policies. That's how I restructure them, because I'm not going to just surrender the 9.5 years of cash I put into the cash value, because I just got a couple more years to wait. I think 3.5 years, and then I can surrender, take the full cash value over to my policy, or I can just keep it and maintain it temporarily. But like you said, what a lot of people don't understand is the IUL structure, the universal life. It's only been around since like 1999 or 2000, and it really didn't take shape or form in 2008 and 9 when the market crashed. Then there's other 3-letter companies out there that I won't name, right? But they just jumped on the bandwagon because the only way you can go, from down is up. So they just sold these IULs like crazy, tax-free retirement, better than a 401k. And they skirt around the illustration of a hypothetical under the AG49 rule. And now there's AG49A and then B, and then they're finding ways to put doublers in there and restructure these with bonuses. But everyone skirts around the word average, right? And people don't understand those illustrations are not average returns. Those are compounding effects at 6.9 or 6.5 or 7 every year, as if you never get a zero. But just for simple math, like Wayne, if I fell for this, but I'm just going to ask you, just for people listening, if you're 35 years old right now, and you have an IUL that you're paying $10,000 a year for, and over the course of 30 years, from 35 to 65, right, the illustration shows that you're giving $300,000 to this product, and your illustration is showing you that you can take $100,000 every year tax-free for the rest of your life, right? So you mean to tell me that if you still live the next 20 some odd years, that some company out there is going to give you, right? Some company's going to give you $2 million tax-free of their money for you only giving them $300,000. And I just ask the consumer, the client, like, would you give me $2 million of your money for only getting $300,000 from me? And they say no. So why would the insurance company do it? Because it looks good on a piece of paper? Like, that's just simple math.
And they're the most profitable financial institutions in the country. And they didn't get them by making frivolous decisions with their money.
But I bought it. I drank the Kool-Aid. I get it. I did it. But just common sense. No company's going to give you 3x the money you gave them and stay profitable. It's not going to happen. So we can dive deeper in that into another podcast alone on the infrastructure of having IUL really works to really get people some clarity and save them from themselves. But just switch some topic for a second here. Or we could piggyback off the IUL if you want to before we touch on this next topic. But I want to touch on the next generation and for children stuff, because I think that's kind of where we can help, like the estates and generational wealth. But I'll just ask you about the IUL stuff. You want to piggyback off anything I said on that?
No, I think we'll have plenty of, because that's what most people are familiar with. We'll have plenty of conversation on the IUL. A lot of it will lend it back to what's out there in an effort to differentiate and educate. So we can definitely move on to the children.
Definitely. All right. And if anyone has IULs right now and they think that it's good, or what they have is what they think works, or they want a second opinion, you can always reach out to Wayne or myself, Hidden Gems, or Do What Banks Do, and we're happy to take a look at what you have that an agent showed you and give you positive critique. We're not going to change anything. We're not in the business of moving something just to move it for commission, right? Wayne and I take a different ethical approach. If something is good for you to maintain, we're going to let you keep it, right? We're just having another add-on of something better for you, and we'll make it work. Wayne?
Absolutely.
So anyway,
I think
yes,
it's a great secondary product.
Awesome. Yeah, it's your next non-qualified asset for life insurance. We'll just say that.
Yeah. The children's play. I guess it kind of comes to me in the same marketing in regards to $1 million baby. If you wanna make your child $1 million baby, or you hear about trust funds, then do this. And it really goes back to the same hypotheticals versus what actually is tried and true. And I think that's the one thing that Gerber has right, is buying insurance policies for the children at birth. And if you structure it properly, just like we talked about the mutually owned non-direct recognition whole life policy with really any carrier, because with the child you can't really go wrong. I still prefer to use the carrier that we kind of lean on the most, just because of the flexibility it provides, and you can roll it over into another policy later, or continue to maintain it and just feed it. But that's really the consistency and funding really their life, because we just came back from nationals, and I borrowed from Hudson's policy to offset some of the cost of nationals because it was expense, and I paid for it to begin with. It's not like he raised the money for the policy, so I'll put it back. But it's just another way to store funds to protect yourself. God forbid something happened to them. It also has living benefits on it for them as well, so that you don't bleed yourself dry trying to take care of their medical expenses. And then you have the consistent growth for the rest of their life, the consistent compounding in dividends, not interest, the compound dividends that it pays that will truly get you to that $1 million baby conversation.
I'll tell you, in my personal opinion, if it was mandatory that every baby that's born has to have one of these specially designed and engineered whole life policies, even if it's for a minimum of $100 a month. Mm-hmm. And that's very simple to maintain and easy when we're spending money on, Dunkin' Donuts and Starbucks $10 lattes and energy drinks, right? And lunches are like freaking $15-20 for a small lunch sandwich and chips these days. you have $100 a month. It should be mandatory that your child has some protection, and their life, right, is going to be a little different than what your life is. And I think that's kind of where we should be going if we can just educate people and understand, like, that's all it takes to start. It's not going to pay for college. You can't do that. It's not a lot for college. But even if you're struggling for yourself, that's easy to maintain. Because if a child's born and you're putting $100 a month in 18 years, you might have $20,000. Well, it might be the first, the last, and maybe a security down deposit on a rental. Right. It could be a meal plan for them. And I have some other clients that have a good net worth, and they put like $5,000 to $10,000 into their 529 college plan, and because that's what they were told. Their kid, they're going to college, and I'm not against it wholeheartedly because it's still a good plan. But I would rather opt out of that and do what I do for my child, which is the 529 alternative, which, I have my website, 529alternative.com, if you guys want to check it out, because that is the better alternative. Now, when you're putting money into a child's policy in different carriers that Wayne and I can get into next time, but now it's protected, it's hidden, it's sheltered. IRS government can't touch it. If they don't go to school, it's not a big deal. And all the money that's been inside of my policies, my personal policy and my son's policy, we don't have to report a single penny to FAFSA for scholarships and financial aid. When clients of mine that have a $500,000 portfolio with their 401ks and another $100,000 with their non-qualified brokerage accounts and crypto accounts and cash, like, you got to report all that. Your kid's not getting any scholarships for that, right? Or any grants. They're paying for it. And if they don't go to school, now you got to take the money out. Or if they're 18 years old and you got $100,000 in that 529 account, well, congratulations, it's tax-free when you take out $20,000 for the first semester. But if the market goes down 20, you just lost $40,000. Congratulations. And you didn't even use the money for those first 18 years. You used yours for your son. I use mine for my son every year. So even though I put $10,000 a year into my son's policy, we're still able to borrow like $5,200 to $5,800 back out of the policy. I pay annual, and we take a trip every year because he was born in December. So last year we went to North Carolina, went skiing, and because we own the policies on a juvenile, some people ask, well, who owns it? What happens when they're 18? Don't worry about it. Even if my son is 20 or 30 years old, I still own it. You own your son. Until we educate our children on how this works, then we can transfer the ownership to them when we think they're responsible. But we're not just going to give them $200,000 and let them go ahead and spendthrift this, right?
Absolutely. Absolutely. I think the only other thing that you didn't touch on in regards to children's policy is a lot of people, especially business owners, talk about putting their children on payroll to save on taxes. And why would you do that? You're subjecting them to the very system that you're trying to avoid. So instead of doing that, why wouldn't you just dump it into an insurance policy? It gives you the same write-off because all you have to do is position. They're the custodian. They take out the trash. Whatever they do around the office, you're still making a contribution to that policy on their behalf, and it could be owned by you independently. It could be owned by the business. Either way, you still get the same tax benefit that you're trying to get without subjecting them to that very system that you're trying to avoid. And all the reasons that you talked about, it's safe. Like, what are you doing with the money that you exited on payroll from your balance sheet, from your business's balance sheet? You got to put it into an account somewhere. So
got to get somewhere.
We're not putting it into the bank because we know better. So why wouldn't you put it into a policy that has all of these other benefits? And I'm not saying that. I am saying everybody should. I'd say everybody should. And I'm not trying to sell you insurance, but if you're serious about building a financial strategy, then insurance, for all the reasons that we talked about, should be one of the pillars of that strategy because of how it stands up everything else.
It should. I mean, I know sometimes we say, and I watch some of these guys on YouTube and some of our counterparts in this space, like, I don't tell people that they should have this and I'll be like, no, I think everyone should. Like, I think all your eggs should be here first. I mean, I would put all my money here if I could. To piggyback off what you said with in regards to business owners, just so everybody understands, LLCs, S Corp, like myself, and possibly Wayne, the same way, we can show you how our business is making the premiums and also the extra cash reserves in our business to overfund the paid up additions. Now, you can't write off that because life insurance, like I said, is not a business expense. It's not an investment. But if our corporation, let's say we're paying $500 a month for our monthly maintenance premium, which I like to call them premium deposits, not expenses like the consumers do. And now my deposits are going in that my corporation is paying. And if Wayne and I have structured our policies like we do our business owners to put in, let's say, $40,000 plus extra, right, into the policy, into what we call the paid up additions. And for everyone out there, just make believe they're like a savings account inside of a different asset. Happens to all life insurance. Where now the 40,000 from our corporation can be put into there. And then if we have access to, let's just say 30,000 on the lowest scale of that 40 back out, now we can take the 30,000 and go buy stuff for our real estate business or whatever company you have, right? You buy green boards, nails, wood, whatever it is. Guess what? Can't you write that as material for your business to deduct? And now, guess what? You're going to earn dividends on the 40 grand, even though you borrowed 30 to go write that off for your business. We can show business owners how to leverage. Hey, you and I, we talk about assets and leverage. We don't talk about growth, gains, arbitrage, spreads, because those are investment questions and metrics. Stop listening to investments and start listening to leverage, like real estate. This is like a line of credit, like a HELOC. That's what this is. You just got to retrain your brain, right? Stop thinking about this as life insurance and investment. Start thinking about this more like an asset, like real estate you can leverage with equity that you build. It doesn't appreciate.
Right. That's actually how I explain it to some people, because everybody, the American dream is to buy a house and they think that they're homeowners. And a lot of times when I explain the way that the policy works, it's the home is the asset. Just like in this case, you're the asset. We're insuring your life, and the cash value that you build in the policy based on what you pay into the policy is no different than the equity that you build in a house when you make the mortgage payment and the extra that you put on the house, which I would never do until I'm shifting it all over from my policy to pay off the house entirely. And then you're still going to maintain your mortgage just like you maintain the policy premium, but just like you borrow from the equity that you built in the house, you're borrowing from the equity that you built into the policy. And a lot of times that helps people understand a little better and wrap their head around how it actually works. But I guess the biggest thing to understand is that you're in complete control. It's really about managing your cash flow and stewarding your funds more responsibly and protecting yourself and those people that are depending on you to provide for them tomorrow and into the future. Because if you're not there, then the only thing that is there is this or anything else that you might have put in place. And
Correct.
All of the assets that you accumulate over time have red tape to cut through before you can get to them. And this one, there's no red tape. If something happens, you show the death certificate or you show the doctor's note and all the red tape is removed. Just like you mentioned borrowing from your 401k earlier, like you have to qualify to do that. You can't just say, hey, I want $10,000 because money's tight. But if you, instead of doing the 401k and falling for the free money, which I used to position as well, like all the take advantage of the free money. But instead of doing that, if you do it here, then you never separate yourself from your money. You always have complete control. It's secure. There's no volatility. You're earning compound dividends whether money is there or not. And if something happens, in case of emergency, break glass, all you got to do is break the glass. You don't have to ask for permission to break the glass. You don't have to fill out a form to break the glass. You just log in and break the glass.
Yeah, it's that easy, right? We work with carriers that make it so simple for us. All Wayne and I have to do is log into our customer portal, right? Request a loan. Takes 7 business days or less to come back to us. And guess what? We're still earning dividends and interest, whether they're between 4, 5, 6%. We're still earning the interest in all the money we put in, whether we borrow it or not. And I know everyone thinks it's too good to be true. But if you get on a meeting or a call or a discovery call with Wayne and myself, even if it's for 15 or 20 or 30 minutes on a Zoom, we will show you our personal policies. We will show you everything to be full transparent so that you understand that this is reality. It's not fantasy. We're not selling you anything or a dream. We have the dream, right? We're using it, right? And people don't understand. They're asking me, what do you mean I have to pay it back? Like, I've never heard of that. Well, now when I explain to them that we're playing by different rules, right? So maybe if you're telling them this when they're asking that question, or you can use my story or the way I explain it, you can use it. But when people always ask me about that, I typically tell them we're playing by different rules because this is not a financial loan like a bank. These are more life insurance loans, which means like when a house appreciates in value, right? The value of the home could be worth $500,000. You owe $300,000. the house has been building that equity. So now you can go apply for a home equity line of credit because the $200,000 you have of equity from the appreciation of the home, you're not going to get 200. No bank's going to do that. But let's say it's $50,000 because they'll give it to you relative to your debt to income and your net worth, right? And your income. But you got to fill out forms, 1099s, tax returns, and that can take 3 to 6 months, which is what one of my clients had told me it took them. But they'll give you that loan, but now you're on a payment plan. If you're late, there's late fees. But you're using the collateral of your house. The value of your property is worth more than you own the loan. So if you did pass away from a catastrophe, whoever inherits that property will sell it for top dollar, pay the loans back, and now you have the rest of the money for your family. But in the life insurance, we qualify more with our health, not so much our finances. So the difference is it comes with a death benefit, which is why this is not an investment, Dave Ramsey. So now our health is our pro and con, right? Sounds too good to be true. Well, if you had, type 2 diabetes and cancer, you're not going to get this as much. Although, I have gotten someone with narcolepsy approved. So if that's the case, I can try to get somebody.
Sure.
But now the death benefit is our collateral. But people think you can borrow the death benefit. You can't. You pay a premium, and the overfunded money, the surplus cash that we put into our paid-up additions, our savings account, we are now going to build our own equity, our own line of credit. So in that example, the $40,000 that the business corporation paid in, now I can borrow a line of credit of that. And the reason why the insurance company will give us some of the money out is because they know if we still pay our premiums, let's say $500 a month, they must pay a death benefit in that contract when we die. Mm-hmm. So now the death benefit is our collateral. So if it's $2 million, like mine is 1.2 at the moment, and if I owe $200,000 right now, then my wife gets $1 million tax free. The loans are exhausted.
Yeah,
that's crazy. And when I explained that to him, he's like, "I never thought of it that way." Exactly, because they don't train us this way. They don't educate you on this. They scare you with tactics of expenses.
Yeah, and that what you just walked through is why people think that you are borrowing from the death benefit, because they don't understand that the death benefit is just the collateral. The equity, so to speak, that you create in the policy is the true leverage that you're borrowing on. So that's a byproduct of people being corralled into the industry and just being thrown out there with word tracks and not real education on how it works. And as a result, you have people running around saying, well, I can pay, what do I do to get $1 million policy? And then they pay their premium, they get it and say, okay, now how do I get a loan for $1 million? Like, that's not how it works. It has never happened to me, because when I hear the questioner, I understand where it came from, and then I explain away and explain how it really works. And it's still a very, very attractive vehicle, but it's also a means of getting them away from that conversation and into the conversation that they should be having. Because once that's off the table and that's not possible, then this makes that much more sense because of the liquidity that you have and because of the mechanics and the way that this actually works versus the way that that's marketed, and then what they get into and realize that it doesn't work. It's classic bait and switch to me.
Yeah. And just before we wrap up, a couple of things, just so everybody understands, Wayne and I talking about different big numbers, or someone's listening and they're like, I don't have 50,000 or 40,000. I don't own a business. I'm not a business owner. I'm just struggling to get by these days. Understand, if I can help a single mother, right, with a 6-year-old take care of all of her $62,000 of debts with her 11 credit cards, her car payment, student loan, and personal loan, right? And I can have the money being taken care of and wipe out the debt within 3 years or less with $500 a month, even though she doesn't have $500 a month. We find the money by asking you questions within our discovery call. Now, the two things that Wayne and I need you to do is, number one, you got to think outside the box, and you have to be an open-minded person. If you can do those two things, we will help you if we can. But then it's more routine. It's more discipline. But I was able to just have her pause her 403B. She's a nurse at a hospital. Yeah. So the 403B she was contributing to get the free money, retirement money, was $500 a month, right? $250 a pay period. So she makes a very decent amount of income. But she's paying close to like $2,400 a month of bills, like debt, not bills, debt. So people listening might even wonder, how the heck are you able to pay $62,000 with only $6,000 a year in life insurance in 3 years or less? How is that possible? Now I'll ask you, Wayne, just to see where you're at. And this wasn't staged, so, just to see your opinion. How am I able to pay $62,000 of debt off the table within 3 years or less with only a $500 a month contribution into premiums? No overfunding, no PUA, just straight premium the way that we know how to design them in whatever blends we do. But how am I able to do that? She's not working harder, right? I'm just having her money work smarter this time by pausing what she's already doing.
Yeah, you're not ever contributing to PUA, or you're reallocating the premiums?
No reallocation. I just use the debt action software that we have, as a tool, and that software is fantastic for anyone listening that wants all of their credit cards and debts and real estate, and we can show you how to restructure this and redirect the funds. But she's not contributing any surplus because she has none. We just paused the 403B that she's currently doing. Only premium, the way that we do our blend of PUA and the term. But how am I able to do that? How can I wipe out 62 grand with only 6,000 a year?
And that's where it is. It's in the blend, and the fact that you're just reallocating those funds and running them here, where she actually has access to the money, instead of, like we talked about earlier, her separating herself from the money by putting in a 403B. Because even though she's making just a premium payment, because it's split, she still has access to funds. And then what we're doing is leveraging those funds to borrow them out and dump it on the debt. And then once the debt is paid off, or we're about replenishing the policy, or even if we want to resume the 403B, because me, and this isn't tax advice and it's not investment advice, but because I am anti those vehicles, I would even venture to pay the penalty, surrender it, and put it all here and just use this as your planning vehicle, because we already know that free money can disappear in an instant. And if something happens to you and you pass away, then they have to jump through hoops to get that money, and then it's going to be taxed immediately before they even touch it. Where over here is going to put them in a significantly better situation, and it's growing tax-free, and you're never without your money again. So as you even get to the other side of that debt and start to use those vehicles responsibly, then it becomes a way for you to create even stronger leverage and even stronger cash flow by being a better steward of your funds based on what you've learned.
Yeah. So we try to go that route the first time for her, but being a 403B and still a defined contribution, she was not able to get a percentage out because she was contributing. So what we did is we just paused the $500 a month, $250, had her take the paycheck, and we just assumed that everything would be $500 a month going in, even though taxes from that would be. She still had a little extra. So all we did is this. The key to paying off debt and the key to money is you have to free up cash, right? That's how we're going to do it. So understand, if we're putting in $500, $500, and in 10 months, we have $5,000 in the policy already. We were able to borrow close to $30-something hundred, let's say $3,500 back out from the $5,000 we put in. And now we paid off 3 little credit cards for that. So we freed up the $75 minimum on one, the $125 on the other, and the $100. So basically like $200 extra is now going to pay the loans back to the insurance company. And the reason why, if anyone's listening, is she was going to pay the $75 a month anyway to the credit cards. You're going to do it. So why not do the same thing you're doing, but earn dividends on all the cash that you borrowed out and wiped it out? So as we went through
free money.
So, and tax-free money. So as we went through this, and I showed her on the debt action software, after the first year and a half, we wiped out 5 credit cards. We freed up $400 extra. So $900 is now going to the insurance company, $500 a month for the premiums on our blend. And then the extra $400 is going to pay the loans off even quicker now. So while we're doing this at the same time, right? Just like a credit card, you pay $400, you have access to it again if you need it. A couple. So that's how we're able to wipe out $62,000 within 3 years, because now once you stop paying the credit cards off, you free up cash to deploy and redirect somewhere else quicker. But the key, she's earning dividends on all the money she borrows at the same time. That's how we're able to wipe out 62 grand within 3 years or less. And she doesn't have a mortgage, right? So it would have been longer. She rents. It's a single mom, 6-year-old. So, but we showed her how to do that. And when I showed her the tears of relief, knowing that she's not just paying the minimums every day, buying or getting credit cards, new ones to pay off the other ones, and doing the whole cycle, the rat race, it was life-changing. And she's in her 2nd year right now, and we wiped out at least 7 credit cards. And she found some extra cash, so it made it a lot easier in her paid-up additions. So just everyone listening, understand, you don't have to have a ton of money. You don't have to be rich. But if you are a business owner, we can definitely save you a ton of money on leverage and cash and write-offs and taxes. We can build your company and scale, earn interest at the same time, whether in real estate, construction. I have a solar guy that does the same thing for solar panels, millions of dollars, or even the customer that's just struggling to pay bills like the single mother. Like, we can help you in some form or fashion. And if we can't, if you have children, let's get them on the right path, even if it's $100 a month. Let Wayne and I help you with just a discovery call. And let's just see where it goes. No fluff, no jargon, just straight talk. Make it easy.
Absolutely. And I mean, I think that's a great place to leave it. If you have any questions, do what banks do on Instagram. For Scott, Wayne runs. For me, obviously, Scott Genad on LinkedIn, Facebook, and Wayne Carr on the same platforms. For me, I think her being in tears and in disbelief and really just wanting to change lives kind of sums up our approach and how it separates us from other people in the industry. There are a couple people out there that we follow, that we talk about, that are similarly aligned.
Mm-hmm.
For the most part, there's a lot of people in the industry that just want the deal. So,
yeah, they just want the sale.
Absolutely.
They just want the sale. Wayne and I don't want to sell 1,000 clients. We can't maintain that. But Wayne and I would love to have at least a couple hundred clients that we can work with direct and just treat you the way you need to be treated and give you that client service campaign that you don't get right now. Because if we help you, you'll just give us all your business. It's just what happens in life, just like a doctor. You feel comfortable and you feel secure knowing that you can trust somebody who's going to help you and your family forever, not someone that's just going to sell you something and move on to the next. So with that in mind, please, we love to hear back from you. Your question that we talked about today, leave them in the comments below. Send Wayne and myself some DMs and give us some topics and questions we could talk about in our next couple podcasts coming up, and we'll address them. So thank you very much. Do what banks do, hidden gems. We look forward to our next podcast coming up soon.
All right, man. It's been a pleasure.